Hi, how are you today? I hope you enjoyed the long holidays. I took the opportunity to spend quality time with my family and continue working on the book I am writing. I would have wanted to continue the lesson second week of January, but when I saw some dead stocks moving, I found it more fitting to share the videos on the pump and dump, a method used by stock market operators to lure their unsuspecting victims. I hope none of you were taken for a ride after viewing the videos. By the way, I'd like to apologize for the delay in the release of this TRTPOB on Module 8. I have been very busy attending to a lot of urgent matters lately. With that said, let us go to Module 8 for the charting. Welcome to the Responsible Traders POB. These are my notes, my own additional research and studies on the topic that I posted, and my personal observations and opinions that I am sharing with you to further enhance our knowledge and understanding. Some of these were previously posted on the Responsible Trader thread of Stock Market Pilipinas. This is the latest version of previous posts I made. Some of these, plus further explanations and discussions, will be appearing in my forthcoming book, The Responsible Trader. Our topic this week is a continuation of Module 2, Charting Basics, where I suggested that you create your own keywords for remembering candlestick patterns. Instead of doing a review of Module 7, let us go over what we have learned so far about candlesticks. A Japanese candlestick is composed of two lines. A vertical line called the shadow or wick, and the full height represents the trading range, plus two horizontal lines representing open and close for the period, usually connected as a rectangle. If you combine the two, you're going to have the candlestick on the right, showing the high, the low, the open, and the close. Japanese candlesticks with real body or very little wicks or shadows are called marubusu. Here is a green marubusu. It is bullish. Here is a red marubusu. It is bearish. A doji is a candlestick with no real body. Dojis signify indecision on the part of the buyers and the sellers. There are four of them: the cross doji, the dragonfly doji, the gravestone doji, and the four price doji. As we learn in Module 2, much of the credit for candlestick development and charting goes to the legendary rice trader named Morihisa Homa from the town of Sakata in Japan. He understood that when emotions played into the equation, a vast difference between the value and the price of rice occurred. This difference between the value and the price is as applicable to stocks today as it was to rice in Japan centuries ago. The principles established by Homa are the basis for the candlestick chart analysis, which is used to measure market emotions surrounding a stock. Japanese candlestick charting is better understood by looking at the historical context when the method was developed. It became popular during the 16th and 17th centuries when the feudal lords waged constant wars with each other. In Japan, this era is known as Sengoku Jidai or age of country at war. This was also the time when the ninjas were used for stealth missions to gather information and murder daimyos or warlords. As a natural consequence, most of the terms used in candlestick charting refer to war, military strategy, and the martial arts. You should not be surprised, therefore, when you see terms like dark cloud cover, morning star, evening star, three white or black soldiers, three rising methods, long white or black line piercing lines, three river bottoms, advanced block, etc. Steve Nissen learned about the method in Japan and brought it to the United States. The method became popular in the US and other countries because it captures market sentiment better than the line charts by providing deeper insight into the direction of the market. It not only illustrates the trend, but also the forces underneath it. The most significant candlestick patterns have been thoroughly discussed in the MCTA video, so I will no longer discuss them here. I will just focus on some salient points. There are three simple rules in detecting candlestick patterns and determining possible actions to be taken. First, size. Larger candles play an important role when identifying patterns. Second, shape. The shape of the candlestick or pattern determines the type of pattern generated, the possible trading signal, and the potential direction of the trend. Third is the location. The location of a candlestick pattern assists in determining the possible trading signal. The location also determines what the pattern is called. Let us now examine these rules by examining some examples. Size. Larger candles play an important role when identifying patterns. The larger and more solid the candles, the higher the sentiment. On the left, we have a chart of nickel showing green candles increasing in sizes. This shows bullish sentiment for the stock. On the right, we have the chart of PSPC showing red candles increasing in sizes. This shows bearish sentiment for the stock. Shape. The shape of the candlestick or pattern determines the type of pattern generated, the possible trading signal, and the potential direction of the trend. On the left, we have the chart of VLL. The pattern is self-explanatory as the green candle engulfs the red candle before it. On the right, we have the chart of CAL during its early trading days. A big red candle engulfs the green candle before it. Location. The location of the candlestick assists in determining the possible trading signal. The location also determines what the pattern is called. On the sides of the chart are typical hammer formations. On the left, we have the chart of Agi, where we see the hammer at the bottom of a downtrend, resulting in a trend reversal. On the right, we have the chart of Costco, where we see the pattern at the top of the uptrend. The same candlestick pattern is now called a hanging man, as it appears at the top of the uptrend. This also resulted in a trend reversal. You can easily convert a series of candles into one. This is an example for a series of candles from a 30-minute chart of DNL from Cole's trading platform. Just identify the open. Here, since the first candle is green, the open for the whole series is the bottom of the first candle's body. Then you identify the highest in the series. It becomes the high. The lowest in the series becomes the low. Since the last candle in the series is green, the close for the series is at the top of the last candle's body. The result of this is a green marubozu with a small wick or shadow. In the absence of additional information, you can read a candlestick by starting with the open and ending with the close. Where you go after the open depends on the color of the candle. If the candle is green, you go to the highest price in the trading range and then proceed to the lowest of the trading range and vice versa. The candle we saw on the last slide is read as follows. Opened at 1612, then buyers bought it as high as 1632. The sellers sold it as low as 1612, same as open, and then the buyers were eventually able to close it at 1630, showing that the buyers are in control, as evidenced by the green candle. There are over 100 candlestick patterns, and you don't have to remember them all. Following are principles to be observed when using Japanese candlesticks when trading. 1. Candlesticks should be used together with other forms of technical analysis, trend lines, support, and resistance. Candlesticks should be used in connection with clear trends, whether uptrend or downtrend. The candlestick patterns are not useful in a sideways market. The more agreement between the signals, candle patterns, and technical analysis, the more likely the reversal. The candle line shows the force behind each move, as well as the price. The candlestick pattern requires both the shape and the trend. A candlestick pattern alone is not justification for a new trade. Candlesticks, no matter how good they are, do not give price targets. And last, you have to set stop loss levels by other means and know when you are wrong and must exit the trade. Let us now go to other chart forms. Except for the candle volume chart, most of them do not use candlesticks. Most of them also are not as widely used as candlesticks nowadays. Let us go over them briefly just to familiarize ourselves with their features. We have here a point and figure chart. Point and figure charting predates bar charts and candlestick charting. It was first talked about in the 1880s and 1890s when it was known by the name Charles Daw used, the book method. The name point and figure seems to have been applied in the 1930s. In comparison, the first reference to bar charts was in 1896 and candlestick charts, although some centuries old in Japan, only came to the West in the 1980s. The point and figure chart plots day-to-day price movements without taking into consideration the passage of time. Point and figure charts are composed of a number of columns that either consist of a series of stock X's or O's. A column of X's is used to illustrate a rising price. As its name implies, candle volume charts merge volume into candlesticks. This allows chartists to analyze both price action and volume with one look at the price chart. The volume is incorporated into each individual candlestick by making the width of the body proportional to it, so that a fat candle shows a lot of trading volume and a thin candle shows little trading interest. The general rule is that in a bullish market, volume and price usually increase. A bearish market often has both volume and price reducing. If a bullish move was not supported by volume, then it would be suspect. Chartists can also look for candlestick patterns as well as classical chart patterns such as triangles and wedges to generate signals. Invented in Japan, three-line break charts ignore time and only change when prices move a certain amount. In this regard, these charts are quite similar to point and figure charts. Three-line break charts show a series of vertical white and black lines. White lines represent rising prices, while black lines portray falling prices. Prices continue in the same direction until a reversal is warranted. A reversal occurs when the closing price exceeds the high or low of the prior two lines. Renko is a type of chart developed by the Japanese that is only concerned with price movement. Time and volume are not included. It is thought to be named for the Japanese word for bricks, renga. A Renko chart is constructed by placing a brick in the next column once the price surpasses the top or bottom of the previous brick by a predefined amount. White bricks are used when the direction of the trend is up, while black bricks are used when the trend is down. This type of chart is very effective for traders to identify key support and resistance levels. Transaction signals are generated when the direction of the trend changes and the bricks alternate colors. The Kagi is a type of chart developed by the Japanese in the 1870s that uses a series of vertical lines to illustrate general levels of supply and demand for certain assets. Thick lines are drawn when the price of the underlying asset breaks above the previous high price and is interpreted as an increase in demand for the asset. Thin lines are used to represent increased supply when the price falls below the previous low. An entry signal is triggered when the vertical line changes from thin to thick and is not reversed until the thick line changes back to thin. As I previously stated, all these charts are not so popular and as widely used today as the candlestick charts. There is another chart that is widely used by traders nowadays, the Ichimoku Kinko. I see a lot of this posted lately by members of the Facebook trading groups. This type of charting is very interesting, so we'll discuss this separately when we take up Module 10. Okay, this will be all for now. Until then, take care and I wish you the best in your learning journey and good luck on all your trades.